Hello, everyone. Very good morning, good afternoon, and good evening to wherever you are. We would like to invite you all for our today's masterclass, AR in Europe and Strategic Outlook for 2021. And for today's masterclass, we have a speaker, Chris Payne. Chris has been working with, and in fact, the founder of Working Capital Consulting, and he started that in 2006. Providing expertise through a dedicated working capital consultancy. Chris has over 35 years of experience in working capital and management consulting. He has spent around 22 years with a large consultancy as managing director and head of business development. And he has also helped developing several working capital solutions, led teams, and supported implementation for multinational clients, including Unilever, Philips, Rolls-Royce, Real Elsevier, and many more. As Chris says, working capital is all about working with people at all company levels to help find where and how the cash and process costs can be improved. He says it's what he enjoys and takes great pride in working capital. So who would be the better person to take us through the session for today on working capital? Chris, over to you.
Thank you very much indeed, Akshay. Good afternoon, good morning to everyone joining us, depending on where you're watching and where you're based. As Akshay said, today we're going to have a look at Europe, what's gone before, what's coming, and how that impacts what we're going to do in next year. I think the first thing to think about is why are we going to expect a change in performance? And to do this, we've put some slides together that show the performance trends across Europe. We've got some slides coming up, but basically Northern Europe has been edging down to 50 days of DSO. Southern Europe had quite a dramatic dive in 2017, and then they've been slowly edging down to 70 days. The Nordics are pretty much flat around 50 days of DSO. UK has steadily been coming down to 40 days of DSO, and that's partly reacting to pressures for a quicker payment cycle in the UK. In terms of the overall metrics, France has the highest DSO, despite having had laws for about 15 years that requires companies to pay within 60 days. Austria and Portugal have the lowest DSO. So what can we expect for each country, and how are things in different sectors? We believe that business to government, driven by government payments, there's going to be an improvement in terms of collections of debtor days business to government, because the government wants to set faster payment terms out to suppliers, so their behaviour needs to change and pay their contracting partners faster. Business to business will probably get a bit tougher. COVID is still going to bite in terms of recovery, and cash flows are going to struggle. GDP is forecast not to grow very much from a low base and contraction last year, so that's going to be quite difficult. Business to consumer, there's a lot of pent-up savings in the consumer market, so potentially there's going to be spending power there and the opportunity to do deals and discounts in that type of trading arena. So if we look at Northern Europe, we can see DSO has been edging down. Inventories have gone up quite a significant amount over that period, and payables went up and then came down again. So relatively strong cash flows there. In Southern Europe, we can see that DSOs had quite a strong fall in 2017, have flattened off but are still reducing there. And now for the businesses in this study, they're actually getting paid faster than they're paying suppliers. Inventories have remained fairly low. Southern Europe's always been a focus for businesses with a basket of countries to focus on improving collections. And whilst they have typically longer debtor days in Southern Europe to Northern Europe, the level of overdues are usually less. So, for example, in Spain, you'd expect 10 to 15% overdues, whereas in Germany, you'd expect on average between 20 and 30%. So whilst the DSOs are lower, the overdues are higher in Northern Europe. In the Nordics, always steady as she goes for the Nordic countries, with pretty flat performance, no real dramatic changes there. And we'll talk later on, we're updating the 2020 results, but from what we've seen of these three, we don't really expect any significant changes next year. If we look at the UK, we can see that DSOs came down quite dramatically again, matching Spain in 2017, and they've been fairly flat since then. There's been a big focus in the UK over recent years through what's called the PPPR reporting on companies telling the government how they're paying their suppliers. And that's a pretty extensive, wide-ranging report, because it covers any company with a turnover over 36 million or greater than 18 million on its balance sheet, or with more than 250 employees. So pretty much every company above those thresholds has to report every 6 months on their speed of payments and their average payments and how they're paying 0 to 30, 31 to 60, 60 plus, with targets for companies in the prompt payment code within 60 days. So as that drives companies to pay faster, they need to increase their focus on collecting money faster. So the opportunities to automate those processes and improve collection will be greater. In terms of COVID, as with everywhere around the world, COVID has had a pretty, and the average shrinkage across Europe for GDP is 7.4%. As COVID moved at different speeds of the outbreak, it had different impacts, but typically Q2 was the biggest impact, and we've got some charts coming up that show that that change in Q2. Q3 there was quite a significant rebound, and I think businesses, as the sort of the and trading opened up, Q3 bounced back very, very quickly, only to be quashed out by Q4 as the winter build-up of COVID infections continued. And that, unfortunately, is going to move into Q1 this year, 2021. So the chances of that bounce back occurring means it's going to be pushed forward into this year, a bit further down. In terms of the growth rates there, we see UK, France and Italy had pretty similar constrictions last year. UK and Germany have the same forecast of expansion in GDP. Italy and France have a larger expansion, and Russia had the least impact, but the lowest growth forecast going out from there. And the reason we've included Russia, of course, it's in the top 5 GDP. We picked a couple of charts on GDP. The top right chart, you can see, I hope, that in the Q3 2020, there was a significant rebound of GDP compared with the previous quarter, with positive numbers and pretty much over 10% growth in that quarter. Q1 and Q2, Q2 particularly had lots of over 10 minus growths. And Q4 again, it didn't grow, it shrank, slipped back into negative GDP territory. On the bottom left, we have a chart from Q3 showing the change in employment and GDP. Employment is in the purple bands, and GDP is in the purple bands and employment is in the blue band. So there was a clear bounce back in that Q3, and of course that's what we're hoping is going to happen in Q2 and Q3 2021. In terms of the cost of credit, and the reason we focus on collecting money in the first place to keep our businesses flowing, the 2021 forecast for interest rates is going to be 0.5%, and the forecast for corporate borrowing is estimated at 1.5%. However, if we take the basket of borrowing and funding options available to companies, the weighted average cost of capital is still predicted to be between 8 and 10% for most sectors, most industries. For higher risk sectors, that rate of working capital, cost of working capital, is going to be greater. Inflation has been falling in the Eurozone since 2013 and is now below the ECB forecast, or rather the ECB target, which is 2%, but will grow slightly in 2021 according to the prospects. So with little growth, little sort of prospect of a huge funding reduction cost, cash and collecting cash is still going to be important as we go through 2021, and it's going to become very important to optimize collection efficiency, partly because we can see that governments are driving companies very much. If we move on to the e-marketplace, forecasts are that debt collection software, the market in Europe, is going to reach about 1.8 billion in the next 4 years. Governments are particularly keen on making sure that SMEs, small, medium-sized enterprises, get paid quicker, and there's pressure on business to government transactions to be more automated and more electronic. PSD2 is the recent European regulation to turn payments into an electronic service, to boost the use of banks, and to make standard payments more reliable for suppliers. There's increasing pressure mandating e-invoicing over the next 2 to 5 years. Mostly, it has to be said, led by governments wanting to reduce the cost of transactions for them. But there's also a need to improve quality and accuracy of transactions, and that can be facilitated by e-invoicing. Indirect procurement, we see, is an area where electronic invoicing transactions facilitated by systems like Coupa are really leading the way, and flipping purchase orders into invoices on Coupa is a normal fact of doing business these days. It reduces the inaccuracy, and it reduces the chances that you won't get paid on time. A recent example we had was of a large IT services supplier who were batching invoices, up to a month's worth of invoices for lots of small transactions. And although they were submitting them electronically, they were in a format that the customer couldn't handle, and therefore they weren't getting processed. And of course, they weren't getting paid. So even if you have electronic transfer capabilities, you've still got to agree with your customer, your supplier, the right type of mechanism for getting those invoices and those transactions processed as accurately as possible. Coming on to one of the sort of bedrocks of working capital and managing both order to cash and procurement to pay cycles and supply chain cycles is the understanding and education around working capital. And the work we've been doing has really highlighted that from the boardroom down to the shop floor, there is a great deal of work to be done to improve the knowledge around working capital. In fact, one of our non-execs, who was a CFO for a leading UK retailer and has worked in the boardroom of many UK retailers, tells us that the least understood report in the boardroom is the cash forecast, and the second least understood document is the balance sheet. Yet, unless we have these sorts of fundamentals driving our business, we're going to run out of cash and we can't put our plans into actions. Collections in Europe is still pretty challenging. We have different languages, we have different cultures, we have different terms from north to south, slow to fast, or short to quick terms. We have Sconto and Netto, which is offering standard discounts for short payment terms. So automating those processes and making those systems work is a tough ask, and it depends on training and it depends on accuracy and matching the system to what the organization needs. And do they have sort of critical mass by country, or do they have to put that into groups to make it work? So improving collections is also about recognizing the end-to-end processes that control those, and modeling the trade-offs between do we offer terms, extending terms, do we offer discounts, do we manipulate for margin or manipulate for cash? And one of the things that we've developed at Working Capital Consulting is what we call the buyer's calculator, or the working capital app. It starts off just by setting up the basics. What's our weighted average cost of capital? Which country are we in? Which currency are we working in? And then from that, we then put in our basic discount and basic terms. We then model various optional scenarios, offering no discount and extending terms, offering shorter terms and increasing the discount. And then finally, that can tell us what impact that has on our margin or our cash flow. So if your finance director asks you to run and develop your deals for cash or margin, you know exactly which way to go. Going forward, key challenges and key solutions for this year. In 2020, all the results that we've seen so far show that even though turnover and revenues have been squeezed by COVID and margins have been squeezed, companies have performed very, very well on focusing on cash. So we've seen almost double cash flows in some businesses, even where revenues have been falling quite dramatically. So as companies shine the light on cash during the need for COVID, that has driven an upturn in cash flowing into companies. Our concern is, as has been in the past, that as soon as companies take that spotlight off cash and start to think about growing profits and growing margin again and revenues, then the focus on cash is going to shrink, and the appetite for doing the things that drive cash flow is going to change. So as the hunts for profit return, the cash flow focus will weaken. Another area where I suspect there may be issues is the change in our employment practices, working from home, working remotely, people leaving the skill sets that they had before, transferring into other activities. So I think there may be some impact in terms of the skills that we have as employment support unwinds, what that does to our skills base. So that is another area of challenge. And lastly, I think for challenges, the pressure on faster payments that's moving across Europe to pay suppliers faster is going to trigger the need for quicker collections, because it's cash in, cash out, cash flow. And if we don't get the flows of cash in, we're going to be squeezed paying the cash out. In terms of solutions, as with everything, training and education on working capital. One of our little mottos, 1 + 1 - 1 = 3. If you're optimizing working capital, 10% off your inventories, 10% off your debtors, and 10% on your payables delivers a 30% improvement. But when we talk about working capital, we talk about net working capital. So we take 1 + 1 - 1 = 2. So we're actually devaluing the value that working capital can deliver to a company, just the way we measure it. And lastly, I think it's important to increase the accuracy of transactions and transaction flows. There are so many businesses that have suboptimal collections because of the quality of information and the level of disputes and the level of issues around getting clear agreements, clear terms, clear transactions with their customers. And that will always be an issue that challenges business going forward. Okay, thank you very much indeed. That takes us quickly through that presentation. So, Akshay, would you like to ask for questions?
Sure. Thanks a lot, Chris. A great presentation. Let me just go ahead and ask you this: the question that we have. The question is, why do you look at the trends of working capital and not just receivables?
Thank you. I mean, firstly, I think trends actually tell us what's going to happen based on what has happened, and it's very difficult to see where you're going to go unless you actually recognize where you've come from. So trends give a good indication of what's going to happen. And the reason we look at all of the trends of working capital is that partly our commercial survival depends on cash, not margin. Uh, and markets, they tend to live on EBITDA, companies tend to live on cash. If we see inventories going up, which is consuming cash, if we see payables coming down, which is consuming cash, and we see collections and receivables, or collections drying up, receivables going up, we know that cash is going to be squeezed for that business. So borrowing is going to increase, the costs of debts is going to be more to finance, dividends are going to come under pressure, and potentially that company is going to be exposed to threats. So understanding the positioning around all of working capital can give us a much better idea of how that business will perform. So managing your cash, managing your business is very important, we believe.
Thank you, Chris. Let me go ahead with the second question, which we have is what is it about Europe that creates differences between the length of credit and DSO numbers? I think that's a very interesting question.
Yeah, well, it's a pretty huge geopolitical and economic question. I, my own personal view is it's probably more to do with culture and again temperature than commerce. I don't know the history of why all the days and the terms are different, but my theory is that if it's a cold climate with shorter seasons, you have to do things faster. You have to increase your cycle speeds to get things done quicker. If it's a warmer climate, you know, you've got the chance to be a bit more relaxed. You can take a bit more time. It's a bit slower. The harvest and sort of goes. It all goes back, I guess, to agricultural roots. The harvest times are not as critical. So I think the closer you get to the equator, the warmer the climate, the more relaxed the trading atmosphere can be historically, and the nearer you are to the poles, then the faster you've got to get things done because you can't hang around out there. So my own view is it's probably more to do with climate than the economic drivers. But the issue is that there is a difference, and it's probably always going to be there.
Right. So the next question is primarily a clarification, Chris. In one of your slides, there were data points about the overdue percentage in Spain and Germany. The
Yeah.
clarification is asking about like, okay, for the Spain it's like 10 to 15%, and Germany 20+ percentage. Is that something correct? That's the question that the audience have asked.
Okay. All the companies we've looked at, they've tended to have that sort of shape where, because the terms are so long in Italy and in Spain, Portugal, Greece, you've got 100+ days. There is time for the process to work. There is time to make sure you get paid on time, and also the culture is you've got long terms, but you don't want to be overdue. Particularly in Germany, where you've got sconto netto, you've got very short terms of 30 days on average, and sometimes the time available to get those transactions processed isn't sufficient because of quality reasons or whatever, so the overdues tend to be higher. My experience working with US companies was they tended to look at Southern Europe and say, collections bad. They look at northern, sort of Central Europe, say collections good, but they were only looking at the days relative to each other and not the quality of the speed or the level of overdues. And so in Germany or in sort of Nordic countries where you've got higher percentages of overdue, because the overall DSO was lower at sort of 35, 40 days, they didn't get as excited about that as where they saw 130, 140 days of DSO in Italy and in Spain. So, I mean, it's been there for a long time. It's changing slightly in terms of Spain because they've taken a dramatic turn in improving payments. but the differences are still there in terms of how that works out for collecting money.
Right. Let me now get to the next question. In your opinion, what factors make a successful AR automation project and what does not?
I think there are two words that come to mind on that. It's force and fit. If you take a system and you force it into a business without making sure it's going to fit, then the chances are it's going to take a long time and it's not going to work effectively. It's like buying a suit. If you buy a made-to-measure bespoke suit, it takes a long time to get it fitted. It costs you more, but the chances are you're going to wear it all the time, and you're going to feel really good in it. If you take something off the peg, it doesn't fit as well. You may wear it once or twice, but you'll look for a reason not to use it because it doesn't feel that good, doesn't look that good. I think it's the same with systems. If you take time to fit that system to the business, make sure it's got the right structure, it follows the right processes that complement the culture and the corporate directions of the business, you've got a much better chance of that system working for longer, getting adopted more effectively. But in both circumstances, you've got to provide enough training for that system to become understood, to become fully operational. Otherwise, people are just going to find workarounds, and the real value of that system isn't going to deliver what you want it to. You're not going to get the cost benefit.
Yeah, that's true. The next question, Chris, that we have is that is there any guidance or benchmark for average overdue percentage or the best practices that one can set the targets for?
We always work on the basis that sort of world-class overdue percentages would be about 2.5%, depending on industry, depending on sector, depending on country of operation. If you're moving up towards 10, 15, 20%, then you've got to have opportunities. We do an awful lot of benchmarks for companies, and they vary quite differently on overdue percentages and DSOs and things like that. But broadly speaking, under 5%, you're getting pretty good. Between 5 and 10%, you're okay. Over 10%, there's opportunity. That's quick off the top of my head what I would say in terms of that guidance, but we'll obviously take that question offline if people have a specific question, and we can share some of our research into that with them.
All right, I think we are already on top of the hour over here. I'd like to thank everybody who has joined us today. And if you do have any questions, you could send us out on our email address. It's info@emagia.com. This is where you could send any more questions, and we'll be happy to respond to those questions. And we'd also want to invite all of you for our next session, which is on a Thursday, March 11th at 10 a.m. Pacific. The topic for our next masterclass is how digital assistants improve order-to-cash operations. So we are looking forward to seeing you again. And thanks a lot, Chris. Thanks a lot, John, for joining us today.
Thank you.
Yep, you take care. Bye-bye.
Thanks. Goodbye. Good night.